Results of the general elections were announced last week, and BJP-led NDA has formed government for a third term. It is important for investors to understand the economic agenda of new government and its implications on the economy and market. Hi, I am Hemant Kanawala, Head of Equity at Kotak Life Insurance, and will share our views in this edition of Market Only. The most important aspect of the BJP-led NDA retaining its majority is policy predictability. In our view, the government will have following priorities over the next 5 years. First, continuity of policy reforms. The policy reforms of the past decade, including supply-side reforms like lower corporate tax rates and PLI, formalization of the economy through the GST law, allowing retirement funds to invest in stocks, the bankruptcy code, RERA, and coupled with social reforms and infrastructure build-out have arguably changed the economic structure for the better. We believe there is more to come over the next 5 years, pointing to positive structural shifts. Fiscal consolidation, infrastructure spending to lower logistic costs, boost to select manufacturing sector, free trade agreements with major economies, focus on energy transition, support for deep tech, and more spending on social infrastructure are likely to be priorities of the government. Second, macro stability. The most reassuring message from the election is that India will continue to focus on macro stability. The government is targeting to keep inflation around 4% with a deviation of 2% on either side, which will support in creating sustainable growth. Headline inflation is likely to come down to 4.5% in FY25 from 5.4% in FY24. Fiscal deficit is to be reduced to 4.5% of GDP by FY26 from 5.6% of GDP in FY24. A current account deficit and forex reserves in excess of $600 billion will continue to provide stability to Indian rupee. Above factors have helped India to become fastest growing large economy and is likely to sustain growth above 6% for next few years. Third, Capex Cycle. The recovery in Capex since the pandemic has largely been led by the government, while private Capex is showing nascent signs of recovery after being on a weak footing for most of the past decade. The confluence of proactive supply-side reforms, improving capacity utilization rates, resilience in corporate and financial sector balance sheets is likely to provide the foundation to unleash a Capex upcycle. Manufacturing as a share of GDP will rise from 14% currently to about 20% by 2030. This will happen by the government's policy focus, shifting global supply chains, and free trade agreements with major trading blocs. Household Capex, which accounts for 37% of total Capex, is expected to do well with a turnaround in real estate sentiment in both the residential and commercial spaces. Fourth, energy transition. India's energy consumption is set to rise steeply with a shift in energy sources from fossil fuels to renewables. Currently, 72% of energy comes from coal and oil, which is expected to come down to 58% by 2034. This will reduce India's reliance on imported source of energy and improve terms of trade. The market is trading at 1-year forward PE of 20 on consensus estimate, which is at a slight premium to long-term average. The markets are likely to consolidate until we get further clarity on future policies of the government. Union budget will be the first such announcement by the government. Looking at the structural drivers of the economy, we believe that such correction offers a good opportunity to increase equity allocation from medium-term view. Wishing you a very successful investment journey.